Hello, welcome to the second part of 1.6, which is all about the accounting cycle. This is going to be taking you through steps 1 through 3 of the accounting cycle. In a short example, it's very similar to what your homework's going to be like. So just let's review the accounting cycle real quick, and then we'll dive right into the problem. Remember, the first thing you're going to do is make journal entries once you recognize a transaction has occurred. And then the second step is you post that information from the journal, which is in chronological order, into the ledger, which is a bunch of accounts or T accounts where they collect the information by account. So all the transactions that have a cash component to it go in the cash account. All the transactions that have account payable component go into the account payable. So you're basically copying from the journal into the ledger. You're copying debits as debits, credits as credits. So you have to do step 3, which is to prepare that trial balance to make sure that the account balances that are in the ledger or the T accounts, debits equal credits one more time. We will in future lectures get into adjusting entries and financial statements and closing entries, but let's get started on that problem. All right, first thing we should do is to write our debit credit rules up at the top. And let's see, I know that assets equal liabilities plus shareholders' equity plus revenue minus expense. And I know that debits increase assets and credits decrease assets. And there's another thing up here that acts just like assets, and it also is a vowel. So expenses increase debits, or debits increase expenses and credits decrease. The opposite is true because it's on the other side of the equation for liabilities, shareholders' equity, and revenue. Credits increase and debits decrease. So let's see what we find here. Shareholders contributed $10,000 cash in the first year of operation. So let's see if we can identify the two accounts. Cash is 1, and since the shareholders contributed, that's probably common stock. All right, so cash is an asset, and it is increasing. So from the company's point of view, so we're going to debit cash $10,000, and we're going to credit, and remember the credits are second and indented, common stock, $10,000. Isn't that clear? Notice the debits come first, the credits are second and indented. Perform services for $8,000, so that's revenue. Okay, so that's going to be a revenue account. And we received cash and a receivable. Okay, so revenue is increasing, so that means I'm going to have to credit revenue for $8,000. Notice that always goes second. And it looks like I have two debits. I received cash, so cash, the asset, is going up $6,000, and accounts receivable, which is also an asset, is going up $2,000. And it's going up because, remember, it has future potential value because those customers need to pay the bill to us, or we will receive cash from customers in the future. The third one says incurred expenses, okay, so that's a big tip-off, of $6,000, paid $3,000 in cash, and $3,000 is still payable. So debits got to equal credits. Let's see. Expenses were incurred, so I bet we're going to increase our expenses $6,000. we're going to credit an asset cash because cash is being reduced because we paid it $3,000 and we need another $3,000 and we still owe that, so that's a liability or a promise called accounts payable. All right, let's see what else we did. So we're going to come back after we make these journal entries and we're going to post them to the T account. And so keep this in mind because I won't be able to flip back to the slide, but remember these thoughts. All right, next, we purchased land. Land is an asset for $12,000. So I know my land, the asset, is going to be debited because it's increasing $12,000. We paid, which means that's going to credit cash $2,000 because cash, the asset, is going down, and we signed a long-term note for the remainder. So we're going to credit a note, but do you know which kind? Is it note receivable or note payable? And you're right, it's note payable because it's a liability, and that liability is for $10,000 because we promise that we're going to pay $10,000 back in the future because we bought the land. Okay, number 5 is something we haven't done before, but I bet you can figure it out because notice the verb paid. That means immediately that I'm going to credit cash for $400. Well, what's the debit going to be to? Well, I'm paying shareholders, and the only time I pay shareholders is when I give them a dividend. And remember, we said that dividend was a contra shareholders equity account. So notice I'm debiting dividends to make dividends go up $400, and I'm crediting cash to make cash go down $400. But remember, when I increase dividends by debiting it, I'm really reducing my owner's equity account because debits decrease overall. Maybe. Oh, it turned to yellow. Okay, here we go. So if I have a shareholders equity account, I know that debits decrease and credits increase. But if this is dividends and the account is dividends, notice by debiting dividends $400, my shareholders equity overall is going down, and that makes sense because I'm not keeping those profits in the business, I'm paying them out. So my ownership of the company is going down because I'm paying dividends out to shareholders. More on that, don't worry if you're confused. Number 6, sold 1/2 the land purchased in number 4. So we sold $6,000 of the land for $7,000 cash. So I got cash, so I'm going to debit cash, $7,000. I'm going to credit land, 1/2 of it is $6,000. This doesn't balance. Did I get more cash than I gave up in land? And the answer is yes, and debits equal credits. So I need another credit. So did I have a gain on the sale of that land? Because I sold it for more than it cost me. So we've made these journal entries. Now let us post them to T accounts. So I want you to go back and look at what we've done, and hopefully by making these T accounts, you'll be able to follow along. So we need a T account for cash because we had cash transactions. We had accounts receivable transactions. We had land transactions. We had accounts payable transactions. And you're saying, how does she know this? Because Remember, we made those journal entries, so we know which ones were impacted. We also have, oh, yeah, I'll have enough room. We have a T account for long-term note payable. We also had transactions for common stock. We also had a dividend transaction. We also will need retained earnings. Retained earnings. We had a revenue account. We had another revenue account called gain. And we had expenses. So I think I've got them all, and let me clean up my little random or my little doogies. All right, so if I go back to the first transaction, that's where the shareholders contributed 10,000 cash in the first year of operation. So I debited cash, so I'm going to put a number 1 because it was the first transaction, and I debited it for $10,000. So notice I'm copying the debit as a debit into the cash account. And then I credited common stock, so I'm going to put a little 1 here, for $10,000. So whether I'm looking at the journal entry or whether I'm looking at these T accounts, I can see that that debit to cash and that credit to common stock go together. The second thing that happened is we performed services for $8,000. We received $6,000 in cash and $2,000 receivable. Well, we debited cash, so journal entry 2. We debited cash for $6,000. We also debited accounts receivable 2 for $2,000. And we had revenue, number 2, of $8,000. So can you see that those two debits with number 2 by them equals the credit of $8,000 to revenue? Okay, that's a good posting. The third one, we incurred expenses of $6,000, paid $3,000 in cash, and $3,000 is still payable. Well, that's where we, in number 3, debited expenses $6,000. We credited cash, number 3, $3,000, and we still owe $3,000, so $3,000 is credited to accounts payable. So again, the debit to expenses is matched by the credits to cash and accounts payable. All right, the other things that happen to us is in number 4, we purchased that land. So we debited land in 4 for $12,000, and we credited cash for $2,000, number 4, $2,000. And we also credited that long-term note payable for $10,000. So again, do debits equal credits, and can you see which debits go with which credits? I hope so. In number 5, we paid the shareholders their dividends. So we debited dividends, $400, 400, and we credited cash, $400. All right, and in number 6, we sold 1/2 the land purchased in 4 for $7,000 cash. So cash in number 6 is going to be debited for $7,000, the amount of cash we received. We're going to credit land for half of it, or $6,000. And then we need a gain in number 6. It's a credit for $1,000. So now our debits equal our credits, and the thing that you do now is you figure out what the balance is in the account. And we know that if we have a cash account, that debits increase it and credits decrease it. So I'm going to total up my debits, and I'm going to total up my credits, and I'm going to see what the difference is. And I find that the debit side is bigger, which makes perfect sense because cash should have a debit balance because cash is increased by debits. So the cash balance is $17,600, which is the difference between the sum of the debits and the sum of the credits. Accounts receivable is a little bit easier. It only had one debit, so it has a balance of $2,000. Notice I can tell this is a balance because I draw a line which says balance is coming up, and then I underlined it twice. Land, I had debits of $12,000, credits of $6,000, so the debit side is larger by $6,000. Thus, that's the balance. Accounts payable is a liability, so it's increased by credits and decreased by debits, so it has a credit balance of $3,000. Long-term note payable also is a liability account, so it has a balance of $10,000. Common stock is a shareholder's equity, and it has a balance of $10,000 as well. Dividends has a debit balance of $400. Retained earnings, there's nothing in it right now. Revenue has a credit balance because revenue is increased by credits, decreased by debits of $8,000. Gain is another revenue account. It has a balance of $1,000. And expenses are increased by debits, so expenses have a debit balance of $6,000. So notice I've journalized, I've posted, and I have now found the balances in these accounts. So what I'm going to do now is to prepare financial statements. And it's going to be pretty easy because we know the income statement is what we're going to prepare first. And the income statement is made up of revenue and expense accounts. And then we're going to do the statement of retained earnings. And then finally, we're going to do the balance sheet, which is the assets, the liabilities, and the shareholder's equity. So let's see how we do. So number one, we're going to do the income statement. And if I look back, I had revenue of $8,000 revenue plus $1,000 gain. So my total revenue comes to $9,000. My expenses were $6,000. So the net income, revenue minus expense, is net income, or $3,000. That net income goes down to the statement of retained earnings, $3,000. This was a brand new company, so my beginning retained earnings was $0. We also know that we had dividends of $400. All right, so far. So what is our ending retained earnings going to be? It's going to be $2,600. So $2,600 is my ending retained earnings. All right, now cash was $17,600. Other current assets was the accounts receivable, so I'm copying that balance over. It was $2,000. And I also had land, which is a long-term asset that at the end of the year has a balance of $6,000. So my debits, or my total assets, are $25,600. My current liabilities were accounts payable, and accounts payable had a balance of $3,000. Long-term liabilities was that long-term note payable, which has a balance of $10,000. My common stock was also a balance of $10,000. And if I now add up my liabilities plus my shareholders' equity, oh my goodness, it comes to $25,600. That's why they call it a balance sheet. Now, because this was a brand new company, there was no beginning balance sheet, and there's not enough information in this problem really to do a statement of cash flows. But do you see how we can do is, she, BS? So all you'd have to do now is go back and close the T accounts to zero balances. And you don't close all of them. The only ones you close are your revenue, expense, and dividend accounts. But more on that in another lecture. Oops. So what did we talk about? We talked about the first really 3 or 4 steps of the accounting cycle. Making beautiful journal entries, then copying those journal entries into the ledger or the T accounts, and then preparing lovely financial statements. So hopefully this was helpful. Go back and review and go try your homework. Thank you.